I'm Debbie Bell-Hosking of Finextra, and with me is Jost Hoppermann of Forrester. Hello, Jost.
Hello.
Digital transformation. What is the state of digital transformation in banks, do you think?
Actually, there are two perspectives. One perspective is certainly that banks should already work full speed on digital transformation because, in line with Forrester's view, banks should have some kind of end-to-end digital solution in place that truly delivers true digital banking, say within the next 4, 5, 6 years. However, when we look at our data, it is also some kind of positive outlook. Most of our surveys in the recent years told us that 80% of financial services firms are working on digital transformation or plan to start doing so very soon. And then there's reality. And in reality, we have very few banks that have already finalized their transformation process, if there is something like a finalized digital transformation. And most are still planning to transform. They are stuck in early phases of transformation, so that only very few banks are in a position to deliver true end-to-end digital banking with truly modern systems that will enable them to remain competitive in, say, the next decade.
So on that point, how does a bank avoid a digital transformation disaster?
Actually, this is a very good question because, unfortunately, in most cases, disasters tend to become public much faster than the successful projects. And although I said that many banks are still working on digital transformation or they are planning to do so, we certainly see a number of successful projects. But you'd asked about reasons for failure, basically. And when we look at this, one thing is certainly that avoids a failure is very thorough preparation. A typical medium-sized to large bank has a very complex application landscape. Complexity is an issue, so you really need to plan very carefully. At the same time, our research also identified a number of key reasons for failure. Let me only mention one or two. One is certainly that a bank should avoid ill-defined shortcuts, as in to skip over essential steps of a preparation process. One example happened last year here in the UK when a bank skipped some tests for a new solution, and the impact on the customer base was pretty public, to phrase it mildly. Another example for such a key reason for failure is certainly what Forrester likes to call a mentality sourcing mismatch. If a bank, for example, has never been used to change the way how it works, it can create a disaster to go for an off-the-shelf solution. Without very thorough governance, that bank can certainly end up in a situation with a lot of customization, which basically means a lot of additional cost during the implementation phase, and also a very troublesome maintenance, which also means additional cost later on.
So how can a bank enhance its system of engagement while maintaining its legacy core systems?
So the first thing is certainly to look at the characteristics of a legacy core system or a traditional core. A traditional core has two key aspects. It includes system engagement, an architectural element that is designed to support rapid change, and also a system of record, an architectural element that is designed to protect data, to ensure data consistency. And obviously, these two elements are fundamentally different. System engagement can be represented by super fast superheroes, while at the same point in time, a system of record is more kind of a knight in shining armor. Certainly not the same thing here. And this is exactly how the traditional systems look like. So what can banks do? What are we seeing what banks can do if they do not want to replace the systems with all the risk that come with planning, with preparation, with complexity, etc.? What we are seeing is that banks open their traditional core with data APIs, with kind of real-time replication, and they open it up and build modern solutions on the next or right side of the traditional core, delivering modern capabilities, business capabilities, as well as the entire system engagement aspect, so that they can continue to use the traditional core without replacing it, while at the same time offering their customers a homogeneous view on multiple business capabilities with modern user interfaces and the like.
So hollowing the core, how can this benefit banks?
Hollowing out the core is certainly one aspect, one approach how to open up such a kind of traditional core system. Some people understand hollowing out a core in the way that they plan in a very meticulous way what they want to do with the core, when they want to build new capabilities outside of the core, and then they switch off the old capabilities. I do not like this approach at all, for the simple reason that the entire aspect of opening up the traditional core is meant to reduce the amount of change that a bank needs to apply to the traditional core. What we mean by that is the core should simply continue to run in a vastly unchanged way as soon as the data is accessible. And after some time, after we have built the necessary capabilities on the left or right side of the core, or after we have purchased them, this is another option obviously for many non-differentiating capabilities, we can certainly switch off the core. But hollowing out for me means more kind of a virtual approach where we do not use capabilities anymore as opposed to physically switch them off. And given the state of some 50-year-old core solutions, I dare to say this could also create another disaster.
On that note, Jost, thank you so much for joining us here at Finextra.
Thank you much. It was a pleasure.